Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to today's Bull versus Bear webinar. Steve Miley on the call here on the webinar for Trade Day on Monday, the 9th of October. Welcome, everyone. Welcome. We're going to go through our usual regular run through with a slight twist for a Monday where we have the bigger picture look at the shape of the week, what we're coming up this week, to give us an idea of where the volatility points might be through the week. Obviously, if we've got more events, or not, maybe not obviously, if you've got more bigger events coming up later in the week, then there's more likely to be more volatility later in the week, and therefore maybe less volatility at the beginning of the week. If you have a lot of events coming up later in the week, you're more likely to have more like a mean reversion type days, maybe at the start of the week, and then more likely to have impulsive trending type days into the second part of the week. So it doesn't necessarily happen like that, but it's always good practice. I know we're day trading here at Trade Day. I know some of you guys are literally looking at a few seconds in your trades, or maybe 30 seconds, a minute, or 5 minutes, and it's very, very short term. However, I think what you have to keep in mind in here is that you can get a sense of maybe how much there might be more volatility, less volatility, and that might make you tweak your strategy if you feel that we've got a big volatility events coming up later in the week, as we do this week, and you might feel that we're going to have a quieter beginning to the week. Then you may be looking for the markets not to move as much, so your targets might not be as big, your stops might be slightly smaller at the beginning of the week, and then there might be bigger targets and maybe slightly bigger stops as you go into the latter part of the week. So I think it's good practice, even if you are trading very short term, to look ahead, see what we've got for the shape of the week. So first of all, all of this is in the trading room. So when you log on to the members area, where you are right now, just below where you are right now, you get both the technical analysis reports and the fundamental analysis reports from where you're watching this webinar. And so you can go and download these. So we've got the macro matters. This comes out, I always put this out over the weekend. Usually goes up on a Sunday, sometimes on the Saturday. So this went up yesterday. So this is a bigger picture look back at all the major events that have influenced markets over the past week, and then looking ahead, we have the what's ahead as well, part of that, which then gives you the what's ahead, what's coming up in the week. And then so that's a much longer article, as you can see, going into more depth, multiple paragraphs, and looking into the bigger picture factors, the fundamental macroeconomic factors. Then we also publish our weekly recap and update. So this is a much shorter version of pretty much the same report. Just says, what are the main, just in bullet point form, what have been the main factors influencing markets, and then what has been the impact on the markets over the last week, and then what we've got going ahead. So I'm going to use this now to run through, to look back and to look forward, to give us that bigger picture. So last week, we've been speaking about, I haven't stopped speaking about yields being important, bond markets being important to stock indices. You have to have an idea on the stock indices, on the bond market, and where the important levels are on the bond futures and on the yield charts, to have an understanding of why you might see accelerations. There's a positive correlation at the moment between stocks and bonds. So bonds have been selling off and pulling stocks down, and when bonds have seen slight bounces, the equity markets have tried to bounce. So and those higher yields that we saw all through throughout last week, higher yields, lower bond prices on the cash and futures markets have dragged stocks lower. And then we did see a slight rebound on Friday. I'll talk about that shortly. So, and that's being driven by stagflation fears alongside the higher for longer mantra that we have coming from the Fed. Last week, we also had from the ISM, US PMI for both manufacturing and service sector. And we also got global PMI from S&P Global for the rest of the countries around the world, the economies around the world. Generally, most of that data was slightly better than expected, on the better side of expectations. So showing a positive that the global economy is fairly resilient, even though we are slowing down. And then we had the positive surprise. The markets initially went lower on this, but then eventually went higher on this, both bonds and stocks. stocks. So the US employment data was released Friday, notably better than expected. 336,000 jobs added. Plus, there were positive revisions for both July and August. Now, initially, the market sold off on that. Why did they sell off? Because obviously, a strong job market could put potentially upward pressure on hourly earnings, on a tighter labour market means potential upside pressure on wages. Upside pressure on wages. Wages could then lead to upside pressures on prices. Upside pressures on prices potentially means then the Fed becomes more hawkish. So the initial knee-jerk reaction was lower. When we dug down into the data, what the data showed us in here significantly were a lot of this was being driven by people returning to the workforce. Okay, people returning to the workforce. So that doesn't necessarily, it's not necessarily more demand. It's people returning to the workforce. So that won't necessarily put upward pressures on hourly earnings. And actually, hourly earnings were fairly tame. Okay, and the data from the ISM also early in the week showed that as well. So that was then seen maybe more as a positive. Maybe it doesn't put pressure on the Fed to hike rates, and but then it shows that the economy is fairly robust. At least the labor part of the labor part of the economy, the jobs part of the economy is looking fairly. The employment part of the economy looking fairly solid, and that's seen as like a positive for the US economy and global economy. So eventually that data was seen as more positive when we drilled down into the data, and then hence we saw a move back higher in bond prices, lower yields, and we saw a push higher in stock indices. So stock indices went down and then back higher, hinting at bases. I'm going to talk about the bases there potentially. US and global yields did go to new highs, but backed away from those new highs at the end of last week. US dollar index went higher, but then set back again. So all of this kind of correlated activity. Okay, gold futures were lower and then rebounded on Friday. They've rebounded further today because of events over the weekend, which I'll come to. This I didn't pick up the events over the weekend. This was written before we had obviously what has happened in with regards to Israel and over the weekend, and the war basically that's breaking out in the Middle East, and oil futures were notably lower, with the risk lower. Now obviously we've had some movement in oil as well. We'll talk about that as we go forward. So I wanted to point out, just going into the week ahead, and I do want to return to some of these things about the bond markets and the stocks, and we'll look at the reports that I put out as well on the weekend on the stock indices and also on the bonds. And we'll talk about highlight that as well. So remember, today is Columbus Day holiday, also now Indigenous Peoples Day. Okay, Columbus used to be Columbus Day back in the day. Now Columbus Day / Indigenous Peoples Day. Now this is not kind of a big federal holiday. It's not a markets holiday as such. But what we do see is that US cash bond markets are closed, but stock markets are closed. Okay, so not all states, I believe, recognize it. So it's not like a full-on blown holiday. Is that right? You guys who live in the States will be able to tell me better. But my understanding is it's not a full-blown like public holiday, like national holiday, federal holiday. I think it's done state by state. So, but we do see the cash bond markets are closed. Okay, now given how much importance, okay, there is put to the fact that the bond markets are really been the dog that's been wagging the tail of the stock indices and the other markets as well, the foreign exchange markets, to a lesser extent the commodity markets. But because that has been the case in here over the past few weeks, the fact that the cash bond markets closed may mean that we see kind of a less volatility, because obviously the bond market has been a big trigger for the stock indices. Okay, so with the cash bond market closed, but saying that, the US futures market is fully open. Okay, so the bond futures are open, and the cash equity indices. So Wall Street's open as normal. You can buy stocks, okay, actual cash stocks, and you can also trade the stock indices. So on the futures side, so we have. Futures are fully open, so you guys can trade as much as you want today. I've had quite a few questions coming in this morning already, out of Asia and out of Europe, and also to a lesser extent out of the US. People asking, can they trade today? Yes, you can trade today. There's no restrictions on traders. Normal hours for futures today, but just be aware that cash bond markets are closed. And I did put I posted in the forum. It may mean that you get a little bit of, particularly on the bond futures, you might get the market less liquid. So you might see the market jumping around a little bit more, which then could add to a little bit bit of volatility. Okay, so just watching out for that. And then we have little of note coming up on Tuesday. We do German industrial production. We'll talk about that shortly. Little of note in here coming out on Tuesday, and then the big focus then switches, and then we get the key events for this week. We get FOMC minutes are released, a German CPI as well. That should be noted as well. The powerhouse of Europe, Germany, reports its CPI data coming up on Wednesday, and then Fed meeting minutes from the last meeting. Be interesting to look at those meeting minutes. Okay, we're kind of a bit on a knife edge. Market's not expecting a rate hike. Fed tell us they are going to hike before the end of the year. One more hike to come. Let's see what the Fed minutes deliver on Wednesday. And then the critical data for the week is the US CPI data that we get on Thursday. Also get some Chinese data at the end of the week, EU industrial production and Michigan consumer sentiment on Friday. So the key events really come fairly quickly within less than 24 hours. We get the Fed meeting minutes, and then we get the US CPI data. So we're going to be watching those coming up. I did say I'll revert to the US Treasury market. Now, this is something I've started to share. This is a new addition. If you go to the technical analysis section on the page that you're on right now, normally I share this document every day. You get this document every day. I've renamed it actually now because we've got this second document. So I've renamed this now Index Commodity Technical Analysis Report. Okay, so this gives you the S&P, the NASDAQ, gold and oil. So these are the contracts that most of you guys at Trade Day are trading. So we deliver this. I deliver this to my client base as well. So you've been getting this for some time now. Since we really started Trade Day, we've been publishing this. So, but now I also write this, okay, for my institutional clients. So I've decided to start to share this with you guys as well. Now, not many people are trading the bond futures, but I thought it'd be interesting. And also at the end of this, you've got like this support and resistance table. So it covers the 30-year bond, the 10-year note, the 5-year note, and the 2-year note. So we have 2s, 5s, 10s, and 30s. Gives you the support and resistance levels, okay? And you've got them in this nicely packaged up in this little table. It might be useful just to get this up and have this on your screen to see where these levels are, okay? Because when these levels are breaking, remember there's a positive correlation. Lower futures prices on the bond markets equals lower stock indices, and vice versa. If the bond markets are breaking up through resistance, then it's more likely that the stocks are going to be breaking up through resistance. And you'll see, if we go and look at the 10-year note, you did get this kind of turnaround. You got this spike lower. If I can just zoom in here a little bit on the chart, you'll see we had this kind of spike lower and rebound in here, and it came right near the support from the previous low. So on the 10-year, the 10 years often much watched. We spiked down and then rebounded. So there's potential of a turning point there in bonds. We're a long way from it. Now, if you go and look at all the commentary in here, we're staying bearish. Okay, we're definitely saying bearish. It's clearly in a bear trend in here across the board. But we did highlight previously. Look, on the 2-year. Kind of a bottoming pattern going in. We haven't quite taken out that critical there over there, 101.13.3. Okay, you backed off from that back at the end of last week, but then we spiked lower and rebound. If we can get above that 101.13.3 level on the 2-year, I think it could open up a little bit of upside. But I think it's a useful resource for you guys in here to have that. You've got this easy table to look at. You can just see if we're breaking levels here on support or resistance, it's more likely or not you're going to get significant notable moves also on the stock indices because of the very strong correlation between them at the moment. Okay, so we've got those going on. Just while I'm on it, I want to talk about the US index futures in here. Because basically in the chart you can see I'm staying bearish, but look, bearish for now, okay? So the S&P 500 has got up close to and not quite to this 43.71 level. That's going to be the key trigger point on the upside now. Up through there gives you a Dow theory reversal. It's also fairly not far below in here, these old lows in here as well. You've also got this 50% retracement level in here at 44.0975. So these are going to be some key levels on the upside. The market really needs to get above that 40. And then that could open up notable upside risk for the S&P, but at the moment it kind of just stays bearish. But on the NASDAQ, don't often write these from a different opposite perspective, but NASDAQ actually flipped bullish. We did get so on Friday you saw we got above that low there, sorry, not the low, the high there at 15,060.75. We've been flagging that level as important. That has now created a double, you would argue actually now a triple bottom. It was a double bottom, but after Friday's spike down very close to the other two lows, and we'll look at this on Tradeovate as well when I zoom in. But we went down to these lows. We spiked lower on Friday, close to the previous lows we'd had in here, and rebounded from above those lows, and then created a triple bottom pattern in here now. So that could easily signal a more positive tone, and hence I've written this from a more bullish tone in here. Right, let's run through side things to know. Despite the fact that we're still going to be focused on the bond market, remember the bond market, cash market's closed today, so we can still focus on the futures market, which is open. All the focus, bigger picture in here has now been on the Israeli conflict that we've seen in here, Hamas in here, obviously between Israel and Hamas in here. We've seen market reaction has been a spike in oil prices because of that. Obviously, tension in the Middle East leads to potential concerns about oil supply, which then leads to less supply, higher prices. Basic economics 101. US stocks already in precarious position due to high bond news. This is something I wanted to mention as well. So we're going, while we're on the calendars, where are we here? Earnings. So earnings season kicks in this week for reporting for the third quarter. Going into now, we are the beginning of the fourth quarter, third quarter report earnings season. Actually, we do get PepsiCo tomorrow. We get Walgreen Boots on Thursday, but really it all starts with the big financials on Friday. So I'm not going to go into any detail on this at the moment, but we will be visiting this over the next 2-3 weeks, looking at where these larger stocks are reporting, when they're reporting, just so you've got the heads up on that, because the larger stocks can and often do impact the broader indices, okay, and that's what most of you guys are trading. So we'll be looking at that certainly from Friday. So we do have earnings season coming up, and they mentioned it there, profit warnings coming in, and futures low in here. We're going into kind of risk off mode because concerns around Israel, because concerns about higher oil prices. So you see a strengthening of the US dollar in here. European markets mostly lower, and cash treasuries, we said, closed for Columbus Day, so we're not seeing what's going on with cash treasuries, but we can look at the US Treasury futures markets. So all of this has been about this morning. All the headlines on the major news wires are all around the conflict in the Middle East in here. So oil up, and US equity futures down, and then gold up in here as a safe haven. Gold gains, safe haven status, and again from Reuters, oil prices jumping higher, and then again morning bid oil up but restrained. So yeah, they are up, but not ridiculously higher, and not anywhere back up to the highs that we were seeing a week before we saw last week's significant sell-off. Just a quick nod to the Fed Watch tool. So this has not been really changing. In fact, this has actually crept up slightly in here. Chances of unchanged in here for the November meeting. This has been oscillating between 75 and 80. So the market doesn't believe we're going to get an early rate cut. If the rate hike. If we do get another rate hike, the market's like more pricing in going out to the last meeting of the year on the 13th of December. Remember, the Fed are telling us they will hike rates. That's what the dot plot chart told us. There's a very, very, very good chance. The market doesn't believe the Fed. This has been sitting around 65% for the rates staying unchanged by the end of the year, and then obviously a 35% chance of rates being higher by the end of the year. We've spoken about earnings season in here. Let's go and take a quick look where we are on the major markets in here. So not much change in here from Asian markets overnight. Nikkei was slightly down, the Hang Seng slightly up. If we go and take a look at, so not a massive real reaction really in here from given the conflict in the Middle East. FTSE is actually slightly up in here this morning, maybe being bolstered in here by the fact that you've had maybe seeing the fact that we are seeing, losing my train of thought. And there's a lot of oil stocks, a lot of oil producers in the FTSE and energy providers. So obviously they do better. Okay, so we're seeing FTSE up in here, but the DAX, the German DAX and the French CAC in here are lower by around 0.5% this morning. And if we take a quick look in here at where we are, for the futures, obviously we're up at the end of last week. Let me just open this up in here, and we'll see where we are US futures this morning. I'm just going to quickly do a quick stop on the charts in here, but it will be a quick stop on the charts. Do go and take a look at the reports. So if we go in here this morning, we see we're down about 0.5% to as much as 0.8 in here with the Nasdaq this morning. Okay, so despite having that more positive move that we saw back on Friday, markets suffering because of this concerns about the tensions in the Middle East. Right, a quick, and it will be quick, so, sorry guys, look at the charts, only because you've got the reports there anyway. Let me go and take a quick look at the charts for you. And what I want to focus on, first of all, even though I know you guys are not necessarily trading the treasuries in here, the treasury futures, as I said previously, is open in here. Why has that gone to the H4? I don't know, but I'm going to put the Z and Z back up. There we go. So here we are. This is the treasury. Okay, let me just quickly switch it to the daily chart first of all. So you see that spike down and rebounding, but it wasn't a great run, but you are kind of setting up for maybe a bottoming pattern here. This is the US 10-year note. And then we are opening here today, despite the cash market being up, closed. The market did push higher initially and then back lower in here. And you can see, look where it's stalled. I think this is going to be really important. I mentioned this to you a lot. You know, I like this indicator in here for these longer term shifts, okay, like the swing shifts, the 13-period EMA. Look, you can see in here when we couldn't close above it here, and the market went lower. Then we closed above it here, and it kind of held for a little while, but then we went back lower. And it's been good resistance that the market unable to close above this 13-period EMA. And then there we are at the moment in here. Went right up to it this morning and fell. That 13-period EMA is 107.20 and a half. If the US 10-year future can get above there, I think it reinforces this little potential bottoming pattern. And if I go in here, remember there's that positive correlation in here. Look, and if we go and take a look in here, you've got like a double bottom was signaled. Okay, so we had this double bottom. We didn't quite signal, and we spiked back up through it this morning, and then a little bit of hesitancy in here today. But look, we spiked above it, and then you got this double bottom when we pushed above that level there. If we can get back above there and hold this little peak in here, so this is on the 10-year note. Okay, that 10-year note is 107.12 and a half. If we can get back above there, because we only kind of jumped above it this morning, okay, when we on the open. And remember, the cash market is closed. But if we can get above and hold above that level there, now it may not be able to do it today because the cash market's closed, because you've got no real underlying market to the futures market. If we can get above there, then I think there is potential upside in here for the US 10-year note. And if there's upside for here, then, and let me actually, while we're there, let me just quickly give a nod to the oil market, because a lot of this being driven by oil. Look at that jump up in oil. So you had a really negative big sell-off last week in here, and then that big jump overnight, gap higher. But look at it failing, okay? And where's it failed at again? Look, 13-period EMA. It was really good support through here, 13-period EMA. We turned, we reversed, and then plunged lower, and we've gone right up to it. So maybe oil is fading. This is not a real disaster, given what's going on in the Middle East, okay? If oil fails and goes back and closes this gap, that's going to take a lot of the negative pressures that we've seen overnight because of the Middle East tensions. So if we can get a push back down into this gap on oil, watch that as well. If the oil gap starts to close, we could easily see, and that will be beneficial for stocks, okay? Beneficial for stocks, so watching out for that. Let's have a real quick nod to the stock indices, but it will be quick, guys. You've got the reports there. Why are these all jumped to? It's jumped to 4. I don't know why they've jumped to 4 to the March contract. But anyway, look. So we got this kind of really strong day. That sell off almost down back to the old low, and then a rebound. Really strong intraday rebound in here. Let me go and bring up the ESZ. I don't know why they've defaulted across to lows. Oh, I've done it again. ESZ4. Definitely they want ESZ4. Where are we? ESZ3. Okay. So in here, look, we spiked down on the data and then held above the low there, and then you break back above here and you get a double bottom pattern. And then we'll obviously dip back lower. So I'll be looking for us to actually close it. It's kind of got this intraday gap, the weekend gap in here. I wouldn't be surprised if we try and close that gap in here. Even though I've got that negative view in here, market's kind of holding. Look where it's holding as well in here. If I come in, oh, where's all my stuff gone? Oh, here we are. If I go and put the Fibonacci retracement on, of Friday's rally. There's Friday's rally. Look, we're holding pretty much bang on the 50% retracement. So Friday's rally is like a bit like a Marabuzo candle. So it's not quite a Marabuzo. Marabuzo when it opens on the close, so it opens on the low and closes on the high. So we didn't quite get like a Marabuzo, but there's the length of Friday's activity, right? And we want to see the halfway point hold, and it's holding right at that. Oops, wrong chart. It's holding right at. Let me just move this back across to here and resize that. Yeah, so it's holding bang on that 50% retracement. That 50% comes in at like 43.1575. The low was, sorry, no, that's not true. At 4,300, 43.90, yeah, 4,300 bang on is the 50%, and the low was 42.99.5. So as long as it's holding above there, I think there's maybe we're going to try and close this like overnight intraday gap in here. Now on the Nasdaq, the reason we went positive on the Nasdaq because we had this double bottom setting up, and then Friday went almost down to the lows and rebounded, and then created what's almost like a triple bottom. And you'll see that better on the 30-minute chart. So you got triple bottom here, 1, 2, and then kind of 3. It's not quite there, but kind of 3. And then that was then signaled when we broke down. Sorry, broke above, really. Oh, let me just get rid of that. When you break above that high, we confirm. Now we dip back below that peak there. You see we're just back below. But again, if we put the 50% retracement, if we're looking for that, in fact, we're going to be maybe in here above the 38.2, I think, on the Nasdaq. Very resilient. So the Nasdaq look holding at 38.2. The 38.2% retracement on the Nasdaq is at like 14,965, and we're holding above that. So yeah, I mean, but whilst it's above the 50% even, I would say there's a positivity to the Nasdaq. So yeah, I still think there's upside activity to come potentially today, but you've got to be watching the bond charts. Even if you're trading in ES today, and like you guys are, ES and Nasdaq, I would be keeping my eye on the bond chart, even though the cash market's closed. I'll also you need to keep an eye on the oil market as well, okay? Because obviously the Middle East tensions, if that gets worse, if nothing really escalates, oil could just dip back lower into that gap as well. Bern, so first day with your company, I have to say, seeing all of this makes me feel very good. I'm glad to hear it. That's what we're here for. We want you guys to succeed. You succeed, you win, we win. Okay, so win-win scenario. You win, we win. So that's why we do this. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back with you with another Bull versus Bear webinar tomorrow. Bye.